Welcome to Wacker Chemie AG. My name is Joerg Hoffmann. I'm the head of investor relations for Wacker Chemie. And today I'd like to walk you through the presentation on our Q2 results for 2025. Here you see an overview of our results for the second quarter. It was a more difficult quarter. You saw us pre-releasing with an ad hoc on the 18th of July, following a host of other chemical companies, as we were all experiencing massive uncertainties resulting from trade uncertainties and customers showing a reticence to order. We've all experienced highly volatile order intakes with at times very low levels of orders. All of that led to the fact that we, as many others, had to adjust our guidance for the full year. In our case, the sum of the segments, which I think is the relevant metric to judge the consensus, because there's always funny things in others, was right bang on with the consensus for Q2. But on the full year, we had a need to release. Apart from that, so we ended the second quarter with 1.4 billion euros, essentially at the level of last year. Considering the environment is actually okay, but we had higher aspirations at the beginning of the year. EBITDA came in at 114, EBITDA margin down to 8.1, and unfortunately, EBITDA slipped below depreciation, so net income was negative. The key stories in Q2 were the tariff issues, the trade uncertainty that permeated through all markets and all segments. The fact that we actually completed the vinyl acetate monomer turnaround in Polymers on time and actually on budget, and the fact that we commissioned the etching line in Polysilicon. So that led to a very strong growth in our semiconductor Polysilicon volumes. Actually, in the first half of 25, we sold 30% more volumes into the semiconductor market than last year. So we're on a good track there. On the sustainability side, we established product carbon footprint data, and that was an immediate success. The day we published this, we received thousands of requests from customers for this data. So there was a need for this. This is a good example that sustainability actually matters in business. So as I said, we've adjusted our outlook with an ad hoc. Earlier this year, we adjusted our sales guidance down to 5.5 to 5.9 billion and the EBITDA guidance to 500 to 700 million. The midpoint is where the consensus currently sits. That's okay. That's why we make those ranges. But the key was here the ongoing macro and geopolitical uncertainty, which really hampered demand, not only for us, but for everybody else in the industry. What's compounding the thing for us a bit, though, is the issue in solar, which we're going to touch later when we come to Polysilicon. Another factor was the massive devaluation of the US dollar during the second quarter. We ended the second quarter, I think, with 115 and had started the second quarter very close to parity. So that was a massive headwind, especially in the silicone segment, where we produce in Germany and then ship outside of Germany. And that's the business for us with the highest FX exposure. So what do we do to tackle this? We're obviously not sitting on our hands and just watching the situation. So we continue to intensify our sales activities towards more specialties, increasing customer interaction and driving innovation. Specialties is all about churn. It's about creating new products, finding new applications and so forth. And that's what we do. And actually, that's what we do best. We take a very hard look at improving our cash flows. This primarily targets working capital, but it also addresses inventories and CapEx. The CFO on the call said that CapEx will run below depreciation for the next year and probably the following years. We have built up sufficient capacity so that we can forego CapEx over the next years. And obviously, what we always do is focusing on cost, productivity, and in this case, also optimizing utilization rates, because with low orders, our assets that come with high fixed costs are not that well utilized. Let's move on. Here's the profit and loss. So you see sales, you see the significant contraction in gross profit from sales from 224 to 165. That is a factor of exchange rate and some inflation in raws. Net income became negative. EBITDA margin, we talked about that. On the right-hand side, you see what drove sales. In the bottom right corner, you see this significant effect that sales had much higher than volume and price on our sales. Balance sheet. We entered the quarter with a very solid balance sheet. You well know that Wacker is rather conservatively financed. We still maintain a very high level of liquidity, but working capital went up on seasonality. As the summer season starts, people order more, so this is largely driven from accounts receivables. There was some increase in inventories. Pension provisions went down following higher discount rates, and then there were miscellaneous effects on shareholder equity. The largest one of them were FX effects and the dividend payment. Let's start with our largest segment. Silicones is a fascinating segment. We spoke about this, I guess, before, but silicones are products that you find in all walks of life. By the time that we have finished this call today, you will have been in contact with at least a dozen Wacker products without knowing it. Silicones permeate our everyday life everywhere. And that is because they're so incredibly versatile and they show up in all kinds of industries and all kinds of applications. That means, however, that they also are susceptible to changes in the general economy. So we managed to come up with higher volumes year over year and quarter over quarter. That speaks to our specialties business. But sales were held back primarily by FX, price, and also mix. You will know that a strategy is to focus on specialties and sales. That means we also have standards in the portfolio. And these standards saw massive price pressure, largely driven by Chinese overcapacities that are plunging into the European markets. EBITDA was supported in this quarter by a low double-digit million insurance payment. We had an issue with a supplier whose insurance paid up in the second quarter. The effects of this had hit our Q3, Q4, and Q1 results. So it's kind of reversed a bit of that. Without that, if you do the math, we would have been about at the level of last year in Q2. We were up, but the delta is largely from this insurance payment. So we've updated our guidance for the segment. Now, instead of expecting 10% volume growth, which was something that we saw in Q1, this is now a more muted outlook. You could say it's still ambitious because it's probably, we're not focusing on contraction. But we now see sales and EBITDA at the prior year level. The short-term order behavior just does not lend a lot of optimism there that this could get better. Headwinds from FX and low prices and standards are going to stay with us. And, we hope to have less standards and convert more into specialties, but it also needs a market to sell in. So let's move on to polymers. Polymers is largely represented in the construction industry. More than half of the sales in the typical year are to the construction industry. The construction industry is still in a difficult position, still suffering from the inflation of building materials that needs to correct itself, but also from high interest rates. We saw weak powder volumes in Europe and China, but some seasonal improvement versus Q1. EBITDA was higher, but it would have been even higher, and it showed up quarter over quarter had it not been for the damn turnaround. Also here we've updated the outlook. We now see sales declining at a low single digit. Obviously that could change with the dynamics in the construction industry, but with a margin essentially at the prior year level. And the regional dynamics, softness in Europe and China, our largest markets, that remains unchanged. Let's move on to Biosolutions. And Biosolutions, that is, a large part of this is biopharma. So that's a project business. Most of those projects get invoiced in the fourth quarter. This is why you see this pattern of a strong third and fourth quarter. So we're making some progress there. EBITDA is stable. We've announced a partnership for human milk, oligosaccharides, and there's lots of those things are underway. Let's move on. Polysilicon, as you know, is a two-faced beast. It has the solar business and it has the semiconductor business. The semiconductor business is doing great. We are selling much higher volumes year over year and quarter over quarter. The new etching line that we commissioned this quarter was commissioned on schedule and on spec, and actually better than spec. Fair to say now that we make by far the cleanest material on the planet. This is the stuff that's needed to drive artificial intelligence. And those are the people that we sell to, the people that make those chips and those wafers and those chips. Solar volumes were lower. About a year ago, US policies put a dent into the market, anti-dumping and CVD tariffs against the Chinese processors of polysilicon. This story continues. It puts a lot of uncertainty onto our customers and has obviously dried up volumes. Recently, there have been some changes. The US is moving from a negative list from which country not to buy to a positive list that reduces this whack-a-mole game with producers moving from country to country, like in the past in the textile industry, with more tariffs. So this positive list, Section 232, we are waiting for the implementation of those policies. So until we see that, we can't really comment on it. But what we see, semiconductors looks promising. We expect further volume growth there. And as we replace solar capacities with semi volumes, and for solar, we just have to see where this goes. So our guidance update is not that much a change to where the consensus already saw the numbers. We are seeing now sales at the prior year level with an EBITDA of about 100 million. That reflects both a growing profitable business in semiconductors. It reflects a challenging business in solar and the rundown of solar inventories. With a high fixed cost business, when you pull something from inventories, it affects your EBITDA margin negatively. So those three effects are what's driving the EBITDA. Uncertainties about the PV market in the US remain. This could go either way. We'll have to wait. I hope that when we talk about Q3, we will have something to report there. And then that will be a basis for us to make decisions. At this point in time, we just have to watch where the dice are falling. So here's a view into our net financial position. Continued our CapEx. We paid out a dividend, and combining this with a neutral cash flow from operating activities, we ended the year with 1.13 billion euros in debt. That is more than our long-term target of 1x EBITDA, but it's definitely industry leading. So with this, we're coming to an end to the presentation on the second quarter. Thank you for bearing with me. WACKER is an exciting company. We make tons of things that you would find super surprising. It's a fun place to be at, even in difficult times. Thank you for your interest. And if you have further questions, you'll find my contact details at the end of the presentation. Thank you.
Disclaimer. As described in the legal section on our website, seat11a.com, this publication is for informational purposes only. This means it is not intended to provide you with any investment advice. Any opinion or recommendation expressed by the companies is neither given nor supported by us and should not be considered investment advice from our side. Also, remember that any opinion or recommendation expressed is subject to change without further notice. The content is obtained from sources believed to be reliable, but we do not guarantee its accuracy, completeness, or timeliness. Seat11a.com and its employees disclaim all liability for any loss that may arise in any form from any use of the information in the video, audio, and on our website. We neither express any opinion on the future value of any security or other investment vehicle, nor recommend any investment based on the information provided. Please consider the publications and our website as a platform for companies to present themselves. You need to seek financial advice from an expert regarding the accuracy and appropriateness of the material presented or recommended by the companies in the publication. As we are just considered a publisher, we may hold and trade securities in the presenting company, whether it is a listed or private company. By consuming our content, you agree to these terms and the terms in our legal section on our website.